In Chapter 4, we are going to discuss financial forecasting. Financial forecasting is really essential to the strategic growth of a firm, and it occupies a substantial portion of a chief financial officer's time. It's important for forecasting not only earnings in the future, the balance sheet in the future. It's of critical importance in forecasting cash and cash flow, which the banks really care a great deal about. Banks are unwilling to lend money to companies that don't have a plan for paying it back. So that plan involves financial forecasting. We're going to talk about how that financial forecasting works into the firm's strategic growth decisions, or how it's important in that process. And we're going to look at three financial statements, two of which you've seen if you've had an accounting class, which presumably you've had. The first of which is the income statement, and the second, a balance sheet. In between, we're also going to develop a cash budget. And the cash budget is not a document that accountants worry about greatly, but chief financial officers have to be quite concerned with it. In the chapter, at the end of the chapter, there's a discussion of a percent of sales method, which is not what we'll be looking at right now. But these various methods of forecasting enable a firm to determine the amount of new funds that they're going to need in advance. So this process of financial forecasting is going to force the firm to consider seasonal effects and other effects on cash flow. So let's look at what financial forecasting really is. To begin with, we're going to concern ourselves with constructing pro forma financial statements. Pro forma just means projected financial statements. So these are forward-looking documents that are going to enable our firm to estimate future levels of various assets, receivables, inventory, various liabilities such as payables, and as well as anticipate future earnings and future borrowing requirements. The statements that we're going to look at are frequently required by bankers as a guide to the future. They're unwilling to lend to companies that don't have any idea, haven't thought about what the future holds. And so these statements really are a mechanism for quantifying what's expected in the future. We're going to engage in a systems approach to develop these pro forma statements. So we're going to start out by constructing the income statement from sales projections and from the production plan. The sales projections are going to be determined in concert or jointly with marketing. The production plan, the operations people are going to be involved in that. After we've developed an income statement, we're going to translate that, or convert it in a sense, into a cash budget. That cash budget will tell us how much cash we are expecting to bring in on the revenue side, how much we're going to spend supporting that, and in some months we will have more than enough cash to meet our operating activities. In other months we won't have enough, and we'll need to borrow money from the bank. We need to be thinking in advance how much we're going to need to borrow, and the bank will know we're expecting 3 months from now that we're going to borrow money. They're not going to be surprised when we start pulling down our line of credit, or in some other way borrowing money from the bank. It will be expected, they'll be comfortable with it. All of these materials will then be assimilated into a pro forma balance sheet. Let's look at what the process is a little bit. We're going to start with a sales projection. First step, in concert with marketing, any product that we sell must have been produced at some point. The operating people are going to participate in development of a production plan, and from those two we will develop an income statement which will have sales and expenses. The sales piece coming from the marketing folks, the expenses coming from the operations folks, and then there will be other expenses such as interest expense, overhead, those sorts of things that will be incorporated into the income statement. Once those have been developed, let's eliminate this a little bit, clean up. Once those are developed, the next step is development of a cash budget. The cash budget is going to consider the same information. It's going to be a little more detailed in our example, but there are also things that aren't in the income statement that have an impact on the cash budget. So for example, capital budget. If we buy new equipment, that doesn't immediately find its way into the income statement. It will eventually through depreciation of that equipment, but it requires cash immediately. So we're going to need those other inputs to develop a cash budget. And then finally we'll develop, so that's step 2, so the income statement step 1, the cash budget step 2. The third step, we're going to develop our pro forma balance sheet, which will operate using, first of all, the prior balance sheet. So we'll have a prior balance sheet and we'll make changes based upon retained earnings that comes from the income statement, as well as a number of other changes to liability and asset accounts that we'll see in the cash budget at some point. So that's really the process that we're going to be moving through. Let me clean up here a moment. There we go. So in the next little lecture, we will focus on step 1, looking at an Excel file that will follow along with the tables that you have in the textbook. So all of the tables really up through the end of or through the pro forma income statement, that is I believe table 4.8 in the text. Tables 4.1 through 4.8 will be incorporated into this initial income statement.